two stocks to buy right now. We're diving into the Canadian market for today's video. These both happen to be great dividend pairs in my opinion. What is going on, you guys, and welcome back to the channel. Prior to the video, I just brought up some year-to-date stats on the indices, and we see the NASDAQ has had a really nice pop, halfway through the year, up 34%. That's the QQQ in gray. We see the SPY in blue. The S&P 500 is up 12.5%, which is a nice little bounce. And we see the TSX, the Canadian market, in red, has definitely been the weaker of the bunch, only posting a 4.8% gain. And that's totally okay, because when I'm looking for the different options out there and looking for stocks to add, I don't mind when there's been a weaker index, especially here in the Canadian market. I believe that it may provide some opportunities. A lot of the stocks that I've been seeing, that I've been interested in, do happen to be Canadian. We're gonna dive into two today. As always, do your own research, but let's dive on in. The first stock that we're talking about today is Telus, ticker T.TO, trading at $25 per share. The dividend yield today sits at 5.66%, so a nice starting yield. And we all know Telus very well. Obviously, the company serving over 18 million customers across the country. They do provide healthcare, which is a fun fact that maybe you may or may not know about Telus as a company. They're currently the second largest player in the telecom space if we were to break it down by market cap, with a $37 billion market cap. And for today's segment, I really wanted to focus in on the dividend. Again, 5.66, very, very attractive. They just increased that by 7.4%. So we may be thinking a no-brainer, and it may be a no-brainer in all honesty, but we also want to make sure we're never falling to a yield trap. And this is where, when I look a little bit beneath the dividend, one thing that does jump out to me as a potential, red flag is that Telus has had a choppy history of free cash flow over the past number of years. And in fact, a scary metric that jumps out here in terms of dividend safety is if we look at their payout ratio, which is obviously based on earnings, so the amount of dividends relative to the earnings they're paying out, or even a free cash flow payout ratio, it is sky high. And we have got a common question over the years as to why these telecoms in Canada have these sky high payout ratios, usually right around that 100% mark. And for some people it's a red flag, for some people it's not. These numbers, to me, a 761% free cash flow payout ratio, certainly something to be aware about. Now, the fact of the matter is, with Telus, they have been spending a lot of money. In fact, they spent a ton on capital expenditures during COVID and the previous few years. In 2020 alone, we see that CapEx came in at a high of $5.3 billion, okay? So this is capital expenditures. Now, this is expected to subside. In fact, as they curb spending throughout the remainder of this year and going forward, they're expecting free cash flow to jump by 60%. Stated here, their plan is to decelerate the spending, CapEx spending that is, with an annual target of only $2.6 billion. So that's $2.6 billion that they're targeting in 2023 to spend on CapEx, which is essentially half of what it was when we were looking back here in 2021. And of course, that is going to free up a lot of free cash flow. Free cash flow is one of the many ways in which they can afford to pay out a better dividend. Assuming they're able to pull in this projected $2 billion in free cash flow, I think the dividend should absolutely be more than safe. And this is basically just a chart that shows the dividends paid kind of on the bottom half. So if you looked at total dividends in a given fiscal year, for example, how much they paid, 1.2 billion, 900 billion, whatever it is that they paid out in dividends relative to free cash flow, we see that the bars are pretty even. So it's almost a 1-to-1, but we see right now the free cash flow is sitting at 1.1. If we were able to see that come up at 2, which is again what they're expecting, I think there should be ample coverage with the dividend. One thing to consider on the bottom of this that you may overlook is I've included the share count, or the total outstanding shares with Telus. It has been creeping up. We see since basically 2020, it's been inching up. This has provided a buffer, and in fact, a lot of people are arguing they're almost paying the dividend, with capital raised from issuing more shares, which is probably not ideal. This is something that could be seen as a red flag. It's just something that I'm more or less keeping an eye on. But like I said, monitoring the upcoming earnings, if they're able to get that cash flow up, I think that this dividend should be, quite reliable. If they're able to do so. At the end of the day, this is one of 3 major players in the Canadian telecom scene. The telecom scene is here to stay. It's going to be a great long-term hold. But with Telus, basically over the past year, they've trended down close to 20%. And are we at a bottom yet? Of course, who knows? But I do think it is one to throw back on the radar. It's creeping back on the radar, trading in that $25 range. Now, before we move on, Are you a Canadian watching this video that wants to learn the ins and outs of DIY investing? If so, I'd highly encourage you to check out the Investing Academy. The Investing Academy is our program where we've worked with thousands of Canadians across the country, in many cases starting from complete scratch, meaning I've never actually invested before. Maybe I've had mutual funds and I don't want to pay any more high fees. Maybe I am investing, but I'm just not entirely confident in my portfolio. We can walk you through step by step the entire way, teach you our process from the foundation, the fundamentals, the terminology, investment strategy, researching stocks, the whole 9 yards. We'll be there to guide and support you the entire way. And of course, you get to learn in a fun community-like environment where you can attend our webinars, you can watch our variety of programs, you can interact and mingle with all sorts of other Canadians who are looking to take control and get in charge of their investments. If that sounds like you and you are in the market for online training to fast track your learning journey, take a moment and click the link down below and schedule a call with our team. They'd be happy to speak with you. Now back to the video. Moving on to stock number 2 for today's video is CNR, Canadian National Railway. Ticker is CNR.TO. This one's trading for $154 per share. We see the 2.05% dividend, so it bumped up. I like when I see this stock yielding above 2%. This is stock that does not dip very often, and when it does, I always like to nibble. It's down about 10% off highs, so it doesn't look like too much on this chart, but hey, for CNR, like I said, it's not all too common to see too many drops. This is of course one of 2 major railways in Canada. We already know a strong track record of healthy performance, and despite the recessionary pressures that we've been seeing in our economy, and this is something if you listen to the management earnings presentations, if you go through their calls, they have clearly noted that they're seeing demand drop in various areas of their business. They still posted a very solid quarter across the board. So operating income up 34%, revenues up 16%, super solid. They generated nearly $600 million in free cash flow in the quarter, that is. And more importantly, looking forward, this is always what we care about. They're now expecting to deliver mid-single digit EPS versus previously lower single digit EPS. They confirmed their targets for 8% dividend growth, and they confirmed their share repurchase amount of $4 billion through 2024. So they're clearly rewarding the shareholders as they've done. They've been doing this really since their IPO back in, I believe, 1994 or 1995 via dividends and share repurchases. This is by far one of my favorite charts regarding CNR, and I think a very timely one to share, which is looking at the performance over the past 2 recessions. And I know I'm looking past COVID here, but the 2 major recessions, they performed very well during the dot-com bubble. In fact, actually posting a gain over the couple years there. While they did decline during the financial crisis, as with pretty much the entire market, it more or less traded flat and then went on, of course, to push new all-time highs. And certainly in both cases, they did outperform the market on the downside. This, in my opinion, goes to show the resilience of this business. It goes to show how critical of a function this company plays in our economy. And without many railroad selections out there, like I said, one of 2 here in Canada of their class, this is a significant business advantage. It's a significant moat for the company, and I believe that nothing will really change in the future. This is just CNR. We talk about it all the time. Very much like Telus, this is just an established player in the Canadian market. I think it is a great long-term hold. And while we're not looking at a crazy discount by any means, okay? To be clear, this is not a big value play like we sometimes like to talk about on the channel. I do think it is worth nibbling. If this is one of your long-term holds and you are a little bit under allocated, I think shares are right in line with their historical averages and arguably slightly below. If you want to pinpoint, trading at $154 per share, I think it's another one to throw on the watch list. But those are 2 Canadian dividend stocks that I'm personally like at the moment. Like I said, always do your own research, always do your own due diligence. This is just my opinion, and I'd be happy to hear what you guys think down in the comment section below. If you enjoyed, give this video a thumbs up, subscribe if you're not already subscribed, and of course, as always, be sure to check out our Investing Academy. If you are in the market for online courses and training specifically for Canadians and specifically for DIY beginner investors, if you've never really invested before, if you need a little additional help, or you just want to fast track and just get everything right in front of you so you can just kind of blitz through it and not spend months and months or years learning kind of on your own. We have a program where we've worked with thousands of Canadians, and we work with them every single day to help get their knowledge up to where it needs to be when it comes to DIY investing in Canada. That is our first link down below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.